I'll do kind of a brief introduction here. Um, I run a company called SegStream. I think many of the people on the call will probably know that. Um, I um, I have a vested interest in in the ecosystem, cost segregation, and especially tax. And so we've had this idea kind of kicking around that it would be nice to have more technical calls about subjects that people in the industry care about. So this is sort of going to be kind of the first one of those. And we arrived on a topic here, like sort of you know evaluating what land value is versus land improvements, and we mean that kind of strictly in the sense of establishing a value that could be depreciated on tax return for a property, and mostly in the context of cost segregation. I'm sure there are other reasons to talk about it. Don, anything to add there?
No, I mean, I think that, I mean, today's discussion is a little bit twofold. When you think about land, you've got your land allocation that happens with the purchase. And then you also have, when you talk about versus land improvements, you have your land allocation that happens when you do new construction. It can be a little bit more complicated than you bought a piece of land for X dollars and then you built something on top of it for X dollars. There is still actually sometimes more that needs to go to land in land improvements when you're shaping the land, and that's actually an unknown area. So I think we can talk about both topics because they're actually completely different, but they're both very confusing, and both of them are a target for audits.
Sure. I will just and this is Dawn Paulin, everybody. If you don't know who she is, she's a CPA, very established in the industry, many years. Worked for Cherry Beckert, and now works for Jennings Denovich. Once again, I'm Richard. We started a company here called SegStream. We make cost segregation software, but this is supposed to be a general topic call. It's not to be has anything to do with sales or services or anything like that. It's really just a technical call to sort of get these kind of issues out in the open and get dialogue on them. So with that, and thank you for that introduction, Don. So we'll just go ahead and start. So like I think to start things off, I think for me, when I think about land value and I think about calculating it, I always see it through the lens of cost segregation. And traditionally, just the way things have been done is, okay, well, I'm going to go and I'm going to find what the municipal tax authority has said about what they think the land is value in relation to the land improvements, and I'm going to take those numbers as more or less the Bible, and just, okay, I'm going to apply. If they've done it in a year where they've actually applied it to the purchase price, okay, it's done already. You already have the land improvements value. You just take that, and that becomes the depreciable tax basis that you'll use on the tax return. Or if you don't have the information that's directly applicable to the numbers that you're dealing with the purchase price, then you'll look at the latest data or the data that was closest to it in year. So for instance, like property was purchased this year in 2024, and the last time that the tax assessment was done was last year, and they looked at what they thought the total value of the property was, and they split it into land and land improvements. And you could just say, okay, well, I'm going to take the land improvements value, and I'm going to take that over the total value that they looked at. I'm going to get this percentage, and I'm going to apply that to my purchase, to my purchase price in the case of a purchase. Obviously, in the case of new construction, we're not too worried about that. And like I said, I'm seeing this through the lens of cost segregation. That's why I'm talking purchases and new construction. But if in the case of a purchase where it really matters, you're going to say, okay, we're going to take this factor, which we've established from taking the land improvements value over the total value of the property, or and I'm going to multiply it times what they paid for it. Maybe that comes out to 85%, or maybe it comes out to 32%. I guess it's just, a lot of times it feels like the luck of the draw, depending on where the property is. Out in California here, where I live, there's, if you're anywhere near the coast, you're looking at a lot of property values are much less than the depreciable tax basis sort of factor in that case would be much less than 50%. And that's heartbreaking sometimes. But that's since that's the prevailing way that these things are done, and in a lot of ways it's very rational. I think it makes a lot of sense. I think it's much more defensible than having no basis. And in fact, I've talked with a few tax attorneys on this specific subject because it's something that really interested me. I have friends and family that have gotten into properties and things like that, and we try to figure out how can we maximize the depreciable tax basis. And there aren't too many answers, like concrete answers here. Of course, you could do a land appraisal, and I think that's the other main way that people talk about doing this. I don't know that this gets done very often. And I'd love to hear from anybody who maybe has taken this option. Maybe has anyone on the call, gotten into a situation where it's like, okay, yeah, it looks like we're going to be able to take, 25% of this property, and depreciate it, but we'd love to be able to get more. And looked at getting a land appraisal done, and okay, it's worth it for us to pay $5,000 or whatever we pay to get the land appraisal done, and maybe we'll up that by 10% or 15%. And then of course, if the basis is substantial at all, it would definitely be worth it, right? Because then you'd get a lot more back, at least in first year tax savings. Anybody here gone the route of appraisal? The silence is deafening. Yeah. Don, what do you think about that idea? Like, this is something that I kind of throw around. Oh, somebody raising their hand. Oh, chat is disabled. That's Mike.
Yeah, can people unmute
People can
themselves?
unmute themselves and talk freely here.
Yeah, so we're not worried about chatting per se, but like if you want to unmute, just say that like explain a situation. Hello, Mark. Can you unmute? No.
Me?
Oh, not you. If you want to, Mark, but I was talking about Mark Rideau, the one who was asking the question. Mark, can you unmute or Mark Rideau?
You got me?
Yeah, I got you now. Yeah, so I mean, have you ever, gone the way of the appraisal instead of using sort of just the available, data that's out there on the web? Is the question.
I have considered it, have not. Generally, what I find is about 20% of the time an appraisal will have land value mentioned, but that means 80% of the time it does not. And unfortunately, as you had alluded to, the cost of a land appraisal, I'm finding a minimum of 3,000, and that just seems to be prohibitive for many customers.
Mm-hmm. Yeah.
Don, what about experience that, did like at a bigger firm? I mean, is this something that's usually on the table, or anyone else who's working for, bigger tax firms? I mean, are clients that sensitive to the price of a land appraisal?
No, we never asked anybody to do a land appraisal simply for a cost segregation or just to help, allocate the purchase price to land and building. We certainly had land appraisals if the client had like a conservation easement or a charitable donation or something that needed to be, more, that's going to be, more scrutinized by the IRS. But the method that you talked about, just looking at what the county gives, is generally what I've seen most every CPA do, only because there is no other method. That method is imperfect, though. It's actually interesting, from my view. We work and do, stuff in so many states, and you're talking about like California has that land allocation. When you get into Miami, they have 90%, and it gets to the point where you have to question, do you actually not have any value in this house? Even if it's a fairly new and fairly nice house, it'll have like nothing, and that can't be right. And then when you get out to Hawaii, you would expect it to be maybe 90%, but it's not. Actually, a lot of their land allocations are 25%. It's actually amazing. So this is a little bit like the Wild West, and that's what makes it a little bit easy pickings on audit. Because unfortunately, if like a cost seg study is pulled for audit, land is the absolute first thing they will go to. So what we generally just tell people is you need to have some sort of basis, something in your file that says how you arrived here, something to point back to. And it can be comps. I mean, when you purchase an appraisal, they are just going to go out and look at comps. Actually, a lot of appraisers don't even want to do land because it is just very subjective. So if you have a few comps of just raw land in your area, which is, I know, different than improved land, that's what makes it imperfect, but that can help too, just to put in your file.
Yeah, I mean, I think it's a great point because I'll just take this back to, I mean, I've had conversations with more than one tax attorney on this particular subject. And I heard from both of them that they would not sign an opinion that this is a valid way to do this. And I was like, I mean, that's insane. Since I'm not to use the word insane, but it's incredible that this is the de facto way this is being done on every cost segregation that gets done, and maybe used for other purposes. And I can't get a tax attorney to say that they would actually endorse this as the way to go, which is crazy. But I mean, maybe there are tax attorneys that do endorse it, and I just haven't talked to them. I mean, I thought it was strange that neither one of the people that I talked to thought that was a good idea. You know, and I guess, you know, and the stipulation also was that, like, if there's any value here, like if there's a substantial amount of value in this property in the basis, then I would definitely get a land appraisal done. It was their, you know, that was their kind of go-to, was like, I wouldn't hang my hat on this. I wouldn't write an opinion that says that this is valid. I would go and I would, you know, get a land appraisal. And that's, you know, probably typical from someone who doesn't have to sell that extra service as a part of just selling another, maybe some other services that they're trying to sell. You know, it's no skin off his back. He's just gotta, you know, go and, tell you, well, that's his opinion. And if you have to spend more money, you have to spend more money. But yeah, I just thought it was telling that I would have thought, it would even seemed like, it's weird. It was almost like they treated it like it was a novel idea. This idea that we would,
I think it is
go
a
in.
novel idea. I think nobody would do that.
And-
Aside from the cost, that Mark mentioned, you're talking about time. By the time, somebody wants to just file their return, which they just have to do, and nobody wants to do it. So now they've added the time of doing a study, which they want for the tax savings, but then another laborious cost and time factor for doing a land appraisal. They're just like, nah. I mean, I can't imagine that very many people have ever done that, unless it is a very large purchase and there is nothing to go on, or if they really want to push downward on a high appraisal. I mean, what we've seen is, like, the state of Virginia is very heavy-handed with their land. Have you guys seen that? So I was just saying that we've seen, like, the state of Virginia is very heavy-handed with their land allocations. And I mean, a lot of Virginia is rural, and some of it is, up against DC there in the Nova area, but not the majority of it. So it's actually very interesting. It's very opinionated, and all of property tax and all this is all rooted in state government. So you got 50 states with 50 different opinions. And then, I mean, state of North Carolina has 100 counties. So then multiply that times 50 times 100. I mean, you're never going to get to a commonality.
Yeah, well, and that actually speaks to something I thought about earlier, which is like, what is the standard that's being used by these county tax assessors? Like, how are they, like, if even like most appraisers aren't really doing this? I mean, is there a uniform standard, across the different counties, and how is this being applied? Because I mean, this has such an outsized impact on these tax services, especially cost segregation or any kind of depreciation of improvements. It seems like this is something that should be better known. Are they applying universal land appraisal standard, or is it just county by county, whoever's in the job at the time, is using some formula and no one really knows what it is. It's more of a black box. I mean, I don't know who can speak to that. Did John make the call?
He
Hey,
is,
Richard, this is
John.
Mark Rodriguez.
Hey,
You know, with-
Mark, what's up? Yeah,
Hey.
this is
So with regard
Yeah,
to
go ahead.
that comment there, the assessors, there's a lot goes into the assessors. They have their fair market value, their assessed value formulas and stuff, but they also have social issues that go into their valuations as well. So that's why they're really not fair market value. So to speak, they're more like a mass appraisal with some social aspects to it. That's why you see such a wide range, from municipality to municipality, is because there is no uniform standard that I've come across. Some assessors are very well educated in appraisal. Some of them have never done an appraisal in their life.
Wow.
They just
So-
get elected or appointed there because they were looking for a job and somebody assigned them there. I've had that as well. But the overall topic here of land appraisals, every time I do a purchase price allocation or a cost segregation analysis, which requires a land appraisal, I get a land appraisal done. And I get it done as if it's vacant and available, a grass field. And then from there, I'll add the land improvements on top of that as 15-year depreciable property. So that's how I
Right.
attack them.
But with land improvements, I mean, I guess I'm saying land improvements in the jargon of these municipal tax authorities, but when they say land improvements, they mean anything that's not just, grassland or just trees that were growing
Exactly.
there. Right. Okay.
So it's a hard
but yeah-
thing. You see, they have a different definition. They're not using the same definition that we are, and it gets difficult there. So I very rarely will even look up the assessed value of the land or the improvement, because it tends to be not that accurate. Especially if you do one project where you do an appraisal, you do land improvements, and you check it to there, you'll see there's a significant difference. Because that land value they have may include improvements, and they don't even know that their comps that they're using include improvements. So you have to, make your appropriate adjustments there. That's why I prefer to do my own land appraisals, and then we do them in house, and then
Okay.
we charge the client separately for that.
Yeah. For those of you guys that don't know Mark, I mean, he's probably more, he goes to further lengths with most of his projects, I would say, than most people I've ever met in the business. And, his expertise usually, I would say also goes far beyond most people's. And, but that's interesting. I mean, you guys essentially have sort of a land appraisal department built in. I mean, you're just like where you've recognized this as an issue, and you're tackling it head on by offering this as a service, to pretty much anyone who's going to do, of course, any kind of an evaluation. Is that right?
Exactly. We have an entire evaluation group. We have real estate practice. We do a lot of litigation support work too. So, having, all aspects of valuation and appraisal, under our umbrella there is advantageous for us. So, we can knock out land improvement or land appraisals, relatively quickly. And some cases we'll put an appendix to our report that has a full land appraisal. Other times we'll have a modified one where we put a section into our report, which just, summarizes the comps and just comes up with a value conclusion, the more summarized version of an appraisal of land.
Yeah.
What sort of
Okay.
trends do you see, Mark, then when you do these land appraisals? Do you see, I mean, for example, California and Miami, what kind of land allocations do you see?
Well, I mean, I'm in Jersey, so I do a lot in New York City. I've seen in New York City up to 70% land, and that's working it too, trying to get the value down, with the FARs. But I had an office in Miami for about 10 years, so I'm very familiar with the marketplace down there and the land. But if you value the land as if vacant and available, you should be able to get it down, between 20 to 35%. And then you add your improvements on top of that. But, if you got waterfront property or something down in Key Largo or something, it's going to be a significant factor. Or Star Island, we just did a property on Star Island not too long ago, and land is a different price. People, we were actually valuing one in Key Largo right now, as we speak. That the owner purchased the land and the house for $4.5 million in 2004. And the husband passed away, and then the wife just sold the property to Ecuadorian shrimp guy or something from Ecuador, and he paid $19.5 for the property, and he was going to knock the house down and rebuild a new house. And then next thing you know, about a week later, as we're going through and appraising this thing for estate planning purposes now, and we see the property is relisted. He just relisted it for $26 million. He just didn't do a thing to it. He had it for 2 weeks and relisted it for $26 million. So I guess he decided that was his best course of action. But it's all over the board. It's specific to the area. I mean, if you go inland in Florida from Miami, you'll be 10, 18. I mean, not 10. You'll be 18, 20% for land. But the areas there, Hawaii. Well, Hawaii's been a long time since I've been out to Hawaii value land, but I've just done power plants out there, so no residential, commercial, anything like that. So I can't comment on that. California is pretty crazy with their land numbers as well. Well,
just a practical question here, Mark. I for you, because I'm really glad you're on this call. I mean, you've got you're definitely offering a great perspective here. What about so I think one thing that's probably being left unsaid here is that I think your engagements are feed pretty high in general. I mean, would you agree with that? I mean, because I think some people on this call, maybe they're doing engagements where, look, if the fee is, the fee might be $7,000. It's like, well, if you're going to add $3,000 or $5,000 on top of that, look, you're doubling, your fee is 50% more than what you were going to charge anyway. Do you? Are you guys?
The answer is yes. I mean, I'm working on the Fontainebleau in Las Vegas, and my fees are in excess of $1 million for the Fontainebleau Las Vegas, and I was involved.
But you're valuing. You're not even just valuing. The buildings. I mean, you're valuing everything, probably.
In the Fontainebleau there, in that example, somebody built the hotel and then it sat dormant. Not complete. Let's say 80% complete for 15 years, and then my client purchased it. So I did a purchase price allocation of the land and the building that was there. And as a matter of fact, I've been going through for the past 4 days with E&Y, going through a review of the cost seg, and they didn't like my land value. We're going back and forth. I mean, I had a land value of $118 million for that property, but we made some adjustments to it because of the buildings that were on there. We had it down to $23 million. It had passed audit in 2021, both by Mazar and E&Y. Then E&Y now is reevaluating it, and they want it back up to the fair market value of 118, which we have for the GAAP reporting purposes. So I did a cost seg for GAAP as well, and they wanted both land values very similar, as opposed to the difference that we had there. But we got very creative on that one value down to $23 million. But like I said, it passed audit twice in 21, but did not fly this time. And last night I changed the value back up, and redoing everything now so everybody can get their K1s out to the partner. So my projects are mega projects, but but that's it. I don't want to interrupt your meeting that much, but I'll let you continue back on. If I have anything else, I'll jump in.
Yeah, thanks, Mark. Really appreciate that. And I mean, look, I think it was worth kind of just noting, like the type of projects you handle, because, yes, in a way, you're like that tax attorney who was just like, just do a land appraisal if it's substantial. It's like, and if exactly, if the fees are what they are, like on the projects you're doing, it just makes all the sense in the world. It's like, well, why not just, you don't want to hang your hat on something that could be specious. In the case, if hundreds of millions of dollars are on the line, or even more, who knows?
We're talking, in that project I did, I tell you, we readjusted the land value. I mean, the net present value difference is about $11.8 million tax savings or tax loss going back from back up to 118. That's what we were calculating
Yeah.
last night. So it's significant numbers there. But these are the types of projects that I enjoy. I go after, but I get my fair share of the $5,000-7,000 projects as well. And
Yeah.
those ones are tight and difficult to maneuver around with limited fees and so I know that pain as well, very well, very much so. But yeah, it's very interesting. I appreciate the call. I was interested to hear the other topics and other ways people attack land versus land improvement. So I'll drop back now, let you guys finish, and I'll just listen. If you need me for anything, just yell out. All right.
Sure. Thank you, Mark. Appreciate
Thank you.
that.
Bye-bye.
I do have one question, actually.
go ahead, Dawn.
Oh,
As
there you
we're
go.
talking about, well, Mark actually was wondering how often you have gotten audited, but the other thing I'm wondering is to get everyone's opinions, and as well as yours, Mark, on if anybody has ever looked to their insurance to see what their value is, because generally insurance companies will cover you, like in the case of a fire, up to a certain dollar amount that they think it will cost to rebuild that structure. And that is maybe not a bad idea, because what I am seeing is that when you look on the county assessor and they have land versus land improvements, it really,
but the
I understand
insurance,
that the
the
age,
insurance value though, Dawn, is typically replacement cost or
Mhm.
replacement cost new or reproduction cost. If you take the insurance and use that as a comparison, you got to apply the appropriate amount of depreciation to it, both physical, functional, and
Mhm.
economic.
Right.
To get yourself in that perspective. It seems like it'd be easier just to value the property from using a Marshall valuation service book or something.
And also that doesn't
Mhm.
account for the market value that you paid. Like, so for instance, you buy a property for $10 million because it's like, a hot retail spot or whatever. And then, replacement cost new might be $2.5 million. So
Right.
isn't there going to be a
Well,
huge gap there?
yeah, there should be. That's why I just thought I'd open up the conversation, because it is something that I haven't done, but I've thought about it before, and just maybe as a stopgap. I mean, if you are not going to go for a land appraisal, and if you don't have if you're just a CPA, let's say you're not doing a cost segregation study, and you still have to come up with this land allocation. If there is anybody who has thought about that or done it or anything like that, it's kind of interesting.
Dawn, a lot of times the service will let go by if you're in a normal area, just do an 80-20 split. Just say, hey, 20% is land, 80% is depreciable assets. You can probably get away with that, on these smaller properties, unless the service is going after you for something. Then no matter what you do, you're wrong. So if you did an 80-20 split, I think you're in good shape there.
That makes sense. Yep.
Yeah, but then it's like you said though. The thing is, like, what you don't want to do is get caught with your pants down in an audit, right? Because it's like, well, if they do want to come after you and they're already clawing back because they realize that this client is doing stuff that it looks like they were basically trying to hide, and they were trying to shield, they were essentially trying to withhold money they should have been taxed on. They're going to look at that and they're going to be like, this is absurd. You just said 80-20, right? I mean, aren't they going to just be like, there's nothing like, so in other words, like, you didn't look at the tax assessor, you didn't apply any kind of a standard here. You just said 80-20. I think we already know most of these things aren't going to get audited, but if you ever do come into audit, if they're being aggressive at all, I think they're just going to go back and they're going to be like, if there's any difference between what the tax assessor said and 80-20, I think they're definitely going to be like, oh, look, this plus penalties, it should be.
I think, Richard, what you have to do at that point, Richard, is you got to call somebody like me or get an appraisal done. Because
you got to get someone who's creative.
You got to get somebody that can come in there and value it and withstand the scrutiny and review it with the IRS, because the people that the IRS are not brain surgeons. Whenever I have an audit there, they don't usually know what's going on themselves, but they just sink their teeth into one or two items, and they just hold on to it. I had a client, I had a situation where emergency generator for a movie theater is clearly personal property. I think we can all agree to that. But the agent, he held on to that was 39-year property, and this is a $62 million acquisition. I went to my client and I said, hey, if we just agree to this guy will leave. He goes, all right, get the hell out of my office and move it to 39-year. And we did. We just just
Yeah,
Yeah.
take that,
reallocate,
you
it was
know,
like $100,000. And
and
you know,
take that
maybe adjust
$100,000 and move it
down
over.
door.
Yeah.
Yeah,
Yeah.
yeah, no, you gotta have
Yeah.
your give and your takes. We did recently talk to a representative from the IRS who told us that they just doubled their cost seg audit department. So that's just kind of interesting to know, you know, just this is always one of the first things, you know, that they will look at. So Richard, John is on. If we want to transfer and talk about when you're doing new construction and then you're shaping the land, there is a portion there that also needs to go to land from your actual land improvements. I think that's a topic that a lot of people don't realize.
Yeah. John, do you want to kind of just maybe just, so this is John Denovich, from, Jennings Denovich. He's going to maybe elaborate on that a little bit right now. John, do you mind taking that?
Okay, can you hear me okay?
Yep, you're good.
Okay, yeah, so technical difficulties, my camera, you know, it's not coming on. It's blocked for some reason. But I think
No worries.
what you were talking about, Dawn, the new construction. So, you know, the simplest way for me to describe, you know, where you begin if you have like a piece of land on one side of the road and it costs you know, $1 million, but it's flat and it's ready to build on. Then across the street, you got one that's like very hilly, full of rocks, lots of stuff, lots of work. When you build, you know, new construction, the service wants the clearing and grubbing, which is it's usually not a real expensive item. It's, you know, knocking down the trees, kind of like prepping. And they want that to go to land, okay? So sometimes you will see it on your pay app. And if you see it and it's in the pay app, the service will see it if they do a review. And like Richard says, not a lot of reviews, but we know a lot of money has been sent to the IRS to build up, you know, the idea is that if they enforce the tax code, they'll be able to bring money in, lower the deficit, that type of thing. And we do know it's happening. You know, I was just at a conference recently and there's an IRS agent there and, you know, he's recruiting people even from there, you know, they're just looking for good people. But anyways, the cost of clearing and grubbing is supposed to go to land. Then the shaping of the land. In other words, if you got to flatten that thing to build on it, they want that to go to land too. Now, you're never going to see that on a pay app. You're going to see earthwork, you know, but you will see many times the clearing and grubbing. And that's the simplest way to kind of like try to follow what the IRS wants. Just pull that out, send it to land. And you just hope that you don't get, you know, someone digging in too deep, you know. But if there's things like rock blasting, some big items that really smell like, you know, they were getting the land ready to build on, those are items that are supposed to go to land. Again, you got to get audited, you know. So when I tell my clients, you know, it really comes back to the client. If you get audited, it goes back to the CPA. And, you know, and then the CPA will go to the client and talk about, you know, what's going on. So really, I feel it's the cost seg professional's responsibility to talk to the client and say, what's your appetite for exposure? You know, do you want to roll the dice on this because there's not a lot of audits? It would be hard to find. Or do you want to play it straight and not have to look back over your shoulder? So those are things that we do run into over the years. You know, we've run into that, and that's what the service wants to do. They want those two pieces of the property, the one on one side of the road. You know, you got to be able to get the land ready, you know, to build on.
What do you guys do when somebody, so let's just say somebody does say, yeah, well, I want to be on the up and up here. I want to go the straight and narrow. What is your kind of go-to method of attacking, let's say, an earthwork number to get at the grading, right? So that this is land prep. I mean, do you have a sort of a specific methodology that you guys use?
I'll be quite honest. You know, one of the earlier callers, you know, or people on here were talking about, you know, when you deal with, you know, your Deloittes of the world or PwC, where you're getting an audit and they're coming back to the cost seg team and they're wanting to know, you know, how you arrived at this stuff. Really, you know, I'm working for the client, you know. If I see clearing and grubbing, you know, in there, if I see rock blasting in there, I will talk to them. If I don't see it, and I just see earthwork, what I do is I lean, you know, it's either going to be when any site preparation either has to go to the building or to the land improvements. There is no other choice. They're very clear in the regs. So I lean heavy on the building. So, usually your site, your footprint of your property is more site improvements than it is building. So, I don't split it equally. I put more weight, more weight on the building because, especially when you're, doing a purchase price allocation study, but I always would throw a little extra. So like if I get audited, they're going to see that it's a little bit more per square foot to the building, than it is to the site improvements. And I don't try to go in there and dig and say, oh, I don't see the clearing and grubbing. I don't see the shaping of the land. I don't go there, because I don't know anybody can.
So you don't think so? Like for instance, like they wouldn't like so that if the service was being, like let's just say more, aggressive, are they going to come in and say, okay, like even if you've done it where you said, okay, here's all the square footage of this property that was graded for land improvements. Here's all the square footage of this property that was graded for the building. Isn't it kind of, aren't we talking out of both sides of our mouth if we say that, okay, the service wants any kind of grading that was to prep the land, for this property, they want that in land. And then to turn around and say, well, we're going to actually just put a price, and we're going to actually take, a depreciable cost for grading for land improvements, and we're going to put that into 15-year, and we're going to put a depreciable cost into 39-year for the building grading. But that seems to contradict what we were talking about earlier, which is that any land prep, in general should go to, grading for to put the property into service, or to get it ready to build should just go to land. I mean, how do you kind of reconcile those?
Well, that's really subjective, and every project is different. And I mean, everyone's trying to give a fair price to their clients, and not drive the price up, to give them a good price. There's competitive pricing out there. You can't go back to, you try to get a hold of that contractor, and he's the general, so he's got subs. You can ask for subcontracts, and on any big project, I'm always asking for the subcontracts for the site work and the civil work, because that's where a lot of the stuff is. You just really can't know. What do you do? Go to Google Earth and go back in time and look at the property the way it looked before they started building on it. And that's subjective. You can't even get down to the ground and really see anything. You see a bunch of trees. It really is. It's more subjective. I think, the thought is fair and reasonable. You want to be fair and reasonable, and when you approach these things,
I think that's. That as a rule of thumb. And by the way, I've taken, for those of you who don't know, I actually got my start under John in cost segregation. So, I have repeated ad infinitum, a fair and reasonable allocation, maybe thousands of times over the years, John. It's due to you. And I totally like when you're going to pragmatically, you're going after these things, if you can say, hey, we thought this was a fair and reasonable allocation, and, with a straight face, I think that goes a long way, and you can show that it was fair and reasonable. Like, okay, here were the things that we considered. This is why, we did it this way, and we did this specific methodology. Then I think, that does go a long way. And of course, if there's an auditor who's out for you, they're out for you. And, there might be no, going back from that. Mark, I saw you raise your hand earlier briefly. Did you want to add something? Mark Rodriguez? You're still muted. Might have got another call.
I'm here. I just had to unmute.
Okay.
Yeah. So with regard to like the site improvements under the building and parking lots, let's say the site has different cuts and fills. In audit with the service, if you do the analysis, you can't do it by square feet. You can't do it flat. It's got to be volumetric, because if the building goes off in the back and they have to add land to the back and it's disproportional, if you have a volumetric calculation there of how much volume went to the building and how much volume went to the land improvements, you can substantiate your position. And that's really what the service is looking for, is a volumetric calculation with regard to earthwork and improvements like that to justify between 39 and 15-year property.
What about justifying? So that then my other question though was justifying between what should go to land, like what's just land preparation, and what
Yeah.
should go into even depreciable property.
Yeah, well, yeah, anything you do with clearing and grading obviously is, and grubbing, it goes into land, but I take it usually after they strip off the topsoil, when they start doing the cuts and fills, that's when I start segregating between land and land improvements. But it's challenging to, differentiate that. And, but I've never had a situation that I couldn't get resolved with the service in, over a couple-hour conversation, going back and forth with the property. I would say, try to get pictures that can document it, the before and after to the greatest extent possible. So you have something you can talk about and actually point to, with the service when you go through it with them.
Okay. Oh, thank you.
Yeah, another thing that I want to bring up on the same tone is the import and export of soil. Import and export of soil, the service wants to go to land. So if you're bringing in a bunch of dirt, to level up, they want that to go to land. So in other words, you're trying to get that, like the example of the hilly, rocky property compared to the flat property. That's the theory. If you're bringing soil in or out, that's to prepare the site for all of construction. And I had a situation once, that was very interesting. Again, I'll tell you what, I hang my hat on what's on the pay app. What's the document say? If it says import and export of soil, you're toast. You're gonna have to put that thing. And no taxpayer wants to take any of his construction costs and put them back to the land. They want to capitalize them all. They want to capitalize them all. That's why it's really their choice. It's their decision. You can consult with them and tell them what you think and what you see and what your experience tells you. But really, it should be them that makes the final decision, because it all falls on them. It's their tax return. We had this property up St. John Island off of Charleston, and I saw the import and export of soil, and they literally had to bring in like 4 feet of, to bring the level, because of the, where they were above sea level. They had to bring it, for code permitting purposes. They had to bring it up 4 feet, and we had to do a lot of fancy footwork to determine what was the cost, because it was buried. Once I learned this, I learned this by interviewing, the client, the owner of the property, and why was this, and what was this, and where did we start? And then I found out, we had to bring in 4 feet. And I go, well, that should go to land. He wanted to play straight, and we really had to do some work to figure out how many truckloads it would be, how much the cost, to rent the trucks and bring them in, and all of that. So that was an extreme example. So 25 years of doing this stuff, that was the only time that I ever ran across that. So a lot of this stuff you don't run across every day,
Yeah. Yeah, it's a great point. Look, I mean, we're all playing probabilities in all regards to, in every, sort of substantial, or thing that we do in our lives. And obviously our work, number one, we're all having to make, risk assessments. And of course with cost segregation, there are these kind of hidden spots. And that's kind of, that's what this call is about. But, most people are going to have to just make a judgment call. Hey, is the property here? Is there material, I guess a material, it's a good word for this. Is there a reason for concern? Is it based, just based on, the value of the property or the circumstances? We're all going to be making that kind of call all the time. But, I think that's a great thing of having these calls, is hopefully, people are gleaning the different ways they can go about things. Or if they have a specific question, can come in and answer, or get it answered. Let's see, what was I going to say? Yeah, I mean, I have just from a software perspective, I mean, we've built in the ability to put things, directly into land. So like if you're inputting a pay app, I mean, you can actually have, land, as a sort of, this is just essentially just taking it out of the basis. But you can put it in because you want to put in the whole pay app and have it all add up. I mean, that way there's just a great audit trail. But yeah, I've seen it, definitely, some of my customers using that. Does anyone have anything else to add to this topic? Any questions? Really sorry about the video. I have to work on that next time.
Hey,
John?
Richard,
Oh.
Richard, sometimes we have other, assets that are not owned by the taxpayer, and they go into a non-depreciable category as well. So, if you're doing a
You thinking like
project where
what, cell towers or?
no, like if you're building a project, let's say you're building a project and you have to put a traffic light out on the highway, you got to pay for that traffic light, $150,000 for a traffic light. You don't own that traffic light, you can't depreciate it. So I've had a situation recently with the service where they've gone through and they went through some of my indirect costs that I were allocating, and they identified assets not owned by the taxpayer, and they made me move that over to a non-depreciable category as, hey, you built the project, you can't depreciate that, it's owned by somebody else. So that's another area that winds up being in non-depreciable.
Wow. Yeah. You know what? I totally forgotten about it's things like that, but you're right. I mean, that's a whole other thing where, these things just kind of, and of course, and this is not tax advice, but, I mean, I'm sure many people here have kind of maybe turned a blind eye, sometimes to that, where they're like, well, it looks like this might've been, and especially if it has some sort of a vague name. And maybe it gets even covered under like permits or, some sort of a weird name where it's just kind of like, it's ambiguous what it's for. But that's a great point, right? It's like you bought it, but you don't own it. And for you, you can't depreciate it
can
on your
easily
books if
be
you don't own
considered
it.
soft costs. It's pay to play. It is a little bit like a permit. You had to do it to be able to get the building. You know what I mean? You could make an argument for
But
that. I don't know who does.
You see, Dawn,
But so Mark, did you make that argument?
Dawn, that's where I had the cost. I had the cost in owner indirect costs, and I was spreading it over the project. And that's where they saw it. They saw it in that. They didn't like that.
Yeah.
But what? This thing though, that was the only thing they picked on. They did an entire audit of it was a shopping mall, about a $30 million shopping mall. They audited the whole thing. They reviewed everything, and that's the only thing they picked up on was a $150,000 traffic light. So that wasn't bad though. At the end of the day, I was happy with that review. So I took it out.
What did the line item read? If you don't mind me asking, how did it read in the report?
It was pretty straightforward in there.
Right.
Traffic light or new traffic light. I mean, I won't describe it like that ever again. That, but
yeah, no, you won't.
But I didn't. At that point, to me, I thought, okay, that's you paid. That's an indirect cost to that. But
I think so too. I mean,
most revenue, most service.
But technically,
yeah.
Technically, they're right. I mean, I've had this come up before. I mean, clients of mine have asked me, and it's just like, well, technically, you can't really take that. I mean, but if it says, if the line item is, traffic, I don't know, traffic reformation or I don't know what they, I forgot what the things are like. Yeah, you could be. I mean, yeah, and I think Dawn's right. I mean, there's an argument to make that a soft cost, but you don't own the problem is it's not soft. It's a hard cost.
Yeah.
You didn't pay for it so you could own it. You paid for it so they could own it.
Well, then maybe it's an expense, honestly, because it has to be somewhere you spent the money because maybe it's not depreciated at all. Maybe that's the argument.
Yeah. Well, also,
yeah.
You also, I have a situation where, you're building a large property and you need the electric company to build out a duct bank or a transmission line to come out to your property. And you can either pay the electric company to do it, but they can't meet your schedule, or you could do it. And then you give the asset to the electric company, and the electric company takes it as a contribution in aid of construction, but they don't depreciate it. But the service won't let you depreciate either because it's an asset not owned by the taxpayer. It's owned by the utility. But they, I had one at $6.5 million, to run a duct bank, to this facility. And once again, it was asset not owned by the taxpayer.
mean, from an accounting perspective, does that cost go in your books?
Well, if it depends on how you're doing it. For depreciation purposes, it ain't going on depreciation. The server's not letting it go there. So you have to adjust it for GAAP purposes. I still carry it in there for my GAAP analysis when I do them. But, for tax, I just got to move it over to a non-depreciable category or another category.
Okay, so you leave it on the asset side of the balance sheet and just let it sit. Interesting.
Yeah, I let it sit there so it balances out. I always try to balance out to the ACR or the general ledger or whatever. I try to balance out to that, but I'll put it to another category or it's a non-depreciable. It is something that it is treated similar to land. That's why I wanted to bring it up here at the end there. If anybody ever
Well,
comes
it's a good
across that.
topic. We've definitely had this before. We had a client that had to build a whole parking deck for the city, and then they didn't own that. So it can be extensive, the costs. And I guess if it's worth it to you still to build the building and to pay, everything I know I'm listening to developers talk, that's the burden is getting pretty heavy when they have a lot of these things. And then fitting, it all into an existing tax code is not easy too. So these are all great topics to kind of just bounce around and see how people do things. But Mark, listening to you just reminds me of what, most CPAs and accountants know is that when you get audited, it's a give and take situation. So I have heard other CPAs, I'm not going to say that I advocate for this, but leave something in your pocket that you can play a game with and trade.
Exactly. I agree with that 100%. And I do that all the time. So, but guys, I had to go. I have to get my passport photo and my passport done now. So I had to get in there at 3:00 to the passport office. So I will talk to you guys later. Thank you. It was a great call. I appreciate it. Thank you.
Thank you, Mark.
Thanks, Mark. I think we're pretty much ready to wrap it up. If unless anybody else has any questions or any kind of points they wanted to bring up, we don't need to go the full hour. Does anyone have anything?
It would be great to hear from other people.
Well, go ahead and just unmute if you want to speak, if anybody does.
Richard, Mark Prideaux here.
Hey, what's up?
So I I do mid to lower end cost seg projects. And when I have to do land valuation, I have a couple approaches. One is I try to be like an appraiser, although I'm not. And I have a spreadsheet where I will enter up to 6 sold comps for land, up to 6 for sale comps. I will enter the county assessment, and then I will put down 20% as a historic, and then I will average those. And from the average of those 4, I will see if generally my metric is if it's fallen between 10 and 50%, then it's pretty reasonable. Now, getting comps is not always easy. You got to go to LoopNet or Crexi or Zillow. But in effect, if I had to show that spreadsheet to the IRS, I would have pretty legitimate substantiation for how I came up with it. And of course, you can weight some of those 4 items that go in. And then lastly, for lower end projects, if the county assessment, and again, I understand they don't have their own objective. If the county assessment falls between 15 and 25%, I just go with that.
Okay. Yeah. Well, you're right. No, because then at least you've got something to hang your hat on. If you like the county assessment, I think there's really no problem.
Exactly.
I think everybody here can agree that's the perfect situation. It's like, 10%. That's what I want for land. Great.
The ones I've struggled with the most are like, I had a prospect had $1 million. He purchased $1 million small commercial building in San Diego, and I think the land was assessed at $750,000. And so I'm like, well, let's just look at replacement costs. And I think it was like 2,000 square feet. I forget what number I applied. Just real simple. Let's just say 300 square foot. So replacement costs be 600,000. So you could argue that. So it's a lot art in establishing.
It's a lot art. So the replacement cost gets you kind of back to looking at what the
I like that idea that you just had. I mean, like if you had to rebuild the property here and you couldn't do it for less than $600,000, then how could you possibly say that the land It's like he bought it for $1 million. The land could only be the difference than the replacement cost. I mean,
Mhm.
I think there's a good argument for that anyway. That might strike against other arguments that we have, if we were arguing something else like, reconciliation values, et cetera. But I think it just depends on a case by case basis. But it's actually noon at Pacific time where I'm at, and I have another call. But I really appreciate everyone coming to the call, and we hope to do a lot more of these. And if anybody has any ideas on calls that they, on things that on topics that they'd like to hear about, please email me or anyone on my team. And we'd like to get these going fairly frequently. So thank you everyone for coming. Thank you, Dawn. Thank you, John. And have a great rest of your day.